Hello and welcome to Crux Investor. We're caught up earlier today with Trent Mell. He's the CEO of First Cobalt, Canadian cobalt developer. We talked to him about the fundraising recently, so the equity seems to be sorted. Just now need to deal with the debt component on their rather small capex requirements. So lots of movement since we spoke to them last December. If you want our thoughts on the conversation, their financing, the company itself, you can find that at cruxinvestor.com/club, where you can also find detailed company reports. There's commentary from experts from around the world on a variety of companies and commodities, exclusive to the club. There are training courses on there to help you with your own diligence process, make you a better investor. And of course, there's summaries of other interviews that we've done just to save you some time. And if you want to join a thriving community of investors sharing their thoughts and ideas in a nice, friendly, safe environment, free from trolling, abuse, and judgment, you can find them at cruxinvestor.com/club. Do try it. I think you'll like it. And if you would like to leave your comments below, we'll try to get back to absolutely everyone. Remember to give us a like. It'd be appreciated. And if you want to see precisely what we talked about today, take a look in the description below. Trent, how you doing, sir?
Hey, good. Very well, Matthew. Good to see you.
Yeah, great to see you. We spoke at the beginning of December. How's your Christmas?
Not bad. It was. We had some snow and a lot of time just with the family, but all said and done, we're doing great.
That's good news. That's good news. Because you look like you've been a bit busy, if I'm honest.
I've been busy. Yeah. I got some distractions. If I can't go to a restaurant, I might as well keep my head down and execute. So it's been fun on the corporate front for sure.
Okay, well maybe the board needs to make you stay at home more, because if I look at what's happened since we last spoke, obviously you got money in from the federal government. You are in the middle of a boat deal. You've, I'd like to talk to you about feedstock arrangements, obviously, and you kind of got to the point with Kuya Silver, and you got that over the line. Actually, we spoke to them last week, so a few things to run through there. And of course the US election as well, just to finish things off. So all good. Should we talk about some of those?
Sure. Yeah, you take it away. Happy to take it anywhere you like.
Brilliant. Okay, before we do that, for people new to the story, a lot of new channelists sort of coming in here, can you give them a 1 minute overview of your business, and I'll pick up on some of those topics then?
Sure. I mean, the starting point is, despite some narratives you see out there, cobalt's essential to batteries. It will be for the foreseeable future, other than some lower range stuff. And so with that as a backdrop, most of the cobalt for the battery market comes out of the Congo. Most of that, 80% of that, is refined in China. And so we're trying to replicate that supply chain here in North America. Only cobalt refinery on the continent. And then we've got some interesting mineral assets, particularly in Idaho, which our flagship asset has been under the radar, but it's a huge part of our story once we get the refinery up and running. Okay,
right. So I'm going to point people back to the link below in the description. That was from the conversation we had in December. We talk about business plan, strategy, people, assets, how you're going to move things forward in 2021. Okay, so go to that. I don't want to have that conversation again because there's too much that's happened between now and then. So let's start with money, first of all. Okay, so $1, $10 million from federal and provincial governments. Okay, 2, you've just closed a bought deal, right? And in that context, you're going to be looking to raise some debt. So why don't you just deal with the money side of things, because that's how you're going to finance moving this thing forward.
You got it. Yeah. So our current capex is about $60 million US dollars for the refinery expansion, commissioning. A lot of that being equipment and engineering, because as we discussed, the plant's largely built and permitted, and infrastructure is all there. So what we've done of late, the government came in as a sponsor, as a supporter. So $5 million interest-free loan from the Canadian government. Now I'm talking in Canadian dollars. $5 million grant from the Ontario government. Just under $10 million on the bought deal. We've got this Kuya deal bringing in $4 or $5 million in the short term. So, our equity component of the refinery capex is pretty much dealt with now. Our stated mission here has been not to over dilute our shareholders. So fortunately, with the government announcement, stock price doubled. So it was a much less dilutive equity raise that we're doing now. So the focus is on the debt piece, which is kind of 45 million US is what we would see as the debt component of that. And that's advancing quite nicely now that we've got a few more pieces in place.
Right. So, but what's the order of play? Because the board deal, the money will be in soon enough, right? How do you go about negotiating the debt component now? Because it's more than right. You've got your equity in place. Great. You've obviously the feasibility study, some nice numbers in there, but where are you with those debt discussions now? When can we expect to see that get over the line?
Yeah, we've been fortunate. The inception, we were looking at maybe working more closely with Glencore on the debt solution, but there are a lot of market opportunities. And we've had several lenders standing by, private equity and traditional banks, willing to lend us the money. They've been waiting for us. We wanted to show them line of sight on the feedstock. And so now that we've got that handled, we can talk about that. We're now moving forward. So in fact, this week we're doing the round robin with the lenders, telling them what we're doing. But meanwhile, if I look at our schedule, we've got about 6 months of pre-construction activity, and that started effectively last week. So we've got some long lead order items we need to address, some detailed engineering. And so with a stronger treasury, we're not waiting for the debt to get going, but that should come soon enough, because most of the people we're talking to right now, we've been talking to for more than 6 months, and they've been waiting on us. So now it's kind of game on to move that forward. I've outlined kind of a 60-day, 75-day process here to get to some kind of a finish line. So we'll see how we deliver against that.
Okay, so ideally, in this situation, companies want a kind of fairly vanilla debt structure, right?
Yeah.
And likewise, when people hear the word, Glencore in discussion as well, they get a bit nervous, because those guys know how to negotiate, right? So it's tough to get a good deal there. So what's your preference in terms of what this thing looks like when you're all said and done?
Yeah, my preference would be traditional debt with a bank under kind of a green loan umbrella. And we're having some of these discussions. Glencore, I think we mutually agreed that we're going to be fine without their capital. I will say, they're savvy, but half my team has their roots in the Glencore Falconbridge Extrata days. And so they've been pretty good. Through our feasibility study, we had access to a global team of engineers and metallurgists, learning from their operation, learning from their experiences with cobalt and processing. So that part's been good. We don't need them on the balance sheet. We have $5 million of a loan that we took out over a year ago. The expectation is that we're going to take that out here with this raise. And so it's going to be strictly a commercial relationship with Glencore, where we're buying feed from them and full stop. Now we're close to them in Sudbury. There could be more cooperation, collaboration, but it's going to be market-based commercial terms. Okay.
The other component here is, from when we talked, you're at 13 cents. Within a 2-week period, the price had trebled. So that's nice. People paying attention and listening to you, and you getting out and telling this story, and they obviously believe what you're saying too. And that obviously means that you can negotiate better terms with a traditional lender, obviously, so less dilution, all good stuff. But have you got a thought or a view in your mind as to what price you want to negotiate at? Because obviously debt, it's hard to, in equity, you can go and maybe sell them the idea of a premium, but debt is debt, and it's long term, it's more conservative, risk averse, all of that kind of stuff. Yeah. Do you wait until you think, because we're about to talk about some of the feedstock stuff, some of the PCM contracts, et cetera, et cetera. Do you think there's more to be had if you just wait a little bit?
I think we're having a lot of quiet conversations with them, sort of non-public stuff about our line of sight on offtake, and we've got the feed locked up. And we've got a draft Asenco EPCM contract. So we've got a few things that are advancing nicely. And then the backdrop is the fast markets cobalt quote, which has gone up a lot. In the last 3 weeks, the metal price is up 16%. In the last 6 weeks, the sulfate price is up 28%. So you're looking at almost $23 a pound cobalt in sulfate in China today. And so I think the folks that we're dealing with are following the market. And I think there's a bullishness around green investments, bullishness around EVs, a desire to get exposed to cobalt, and our vision statement now being recast is producing the world's most sustainable cobalt, and that comes from ethical sourcing, and it comes from also a environmental footprint. And so all these ingredients being in Canada, having big commercial partners, not dealing with artisanal feed, I think that's helping us. So I don't feel the need to wait on the debt side. I think we're well positioned to get that done.
Okay, yeah. I mean, I saw that actually. I saw that positioning in terms of a cleaner, greener investment, in the sense that I think you're talking about 51% less CO2 than a typical Chinese producer. I mean, that's got to be pretty impressive for funds when you get to the point where you're sort of chasing institutional investors. Was that the thinking?
Yeah, it is. It is the thinking. ESG funds are trying to get their head around mining. And there are some big ones, some serious ones that are out there. That certainly our stock price appreciation gets us closer to their kind of investment thresholds. One thing that's often overlooked when you look at cobalt from the DRC, which is where most of battery cobalt is coming from, is you've got some big on the ESG front. You've got some big S&G issues to deal with artisanal mining, and just the government there. But from the environmental side, everything there is on a hydro grid, as is our refinery. And so when you talk about, green cobalt from a greenhouse gas environmental footprint perspective, it's a heck of a lot cleaner than these nickel laterite HPAL projects, by virtue of the processing, but also the source of power. So this is going to have quite a broad appeal if people can differentiate between the artisanal feeds and the bigger commercial operations. And there's a lot going on in country to kind of clean up the supply chain and clean up the image through blockchain and better reporting standards.
Yeah, I mean, there's a big discussion around the kind of ESG component. I mean, we've got a few programs going discussing exactly how mining needs to, change. It needs to, rethink the way it does things and the way it talks to the marketplace for sure. But not for now. Give me some insight into the way that these debt deals get structured, because you presumably you want to do it in the best way for your shareholders going forward. And these things don't typically get fixed at the beginning. You have things and conditions which fall away. That's what you would expect to be able to do. So what are the variables that you think are going to work in your favor with regards to how you structure the debt deal?
Yeah, so when you look at the more traditional debt, that's a little bit easier, right? You're modeling out your cash flows. You have an opportunity to take out the debt early in a more buoyant market. And then if you work your way more towards kind of private equity structures, they try to get a little bit creative, and they want to participate on the upside with you. Coupons are higher, and so for us, given that we're buying hydroxide at a market price and they're selling the sulfate rather on market terms. So everything is market based, but those two elements move in tandem, and so we got to be careful as we structure deals at that end of the spectrum that we're not basing everything strictly off the end price of cobalt. It has to be a margin-driven exercise. And so I've got a great team, a great finance team, and some great cobalt contacts. You need to form a bit of a view, but not too much, right? I mean, the cash flows have to drive it. So our view is 5-year debt with an opportunity to take it out earlier. I'd like to avoid all the royalties and streams and all those little sort of add-on features. The equity piece now being taken care of, this should be a fairly straightforward process for us. To me, it comes down to, them getting comfortable with the counterparty risk and then what the coupon is going to be. Covenants, they'll be what they'll be, right? Project debt can be a little bit heavy. You have milestones, you have thresholds you need to meet, ratios and whatnot, but nothing, we'll see. We got 5 counterparties and everyone's a little bit different, but thus far I'm pretty comfortable with most of the term sheets we've seen.
Right. Okay. I mean, right now, obviously, you're focused on getting the thing up and running and getting it into. Yeah. It's a relatively low capex project. Okay. And if I look at some of the feasibility numbers, I mean, 55% IRR is fantastic. It's just sub 200 million NPV 8 number on it. It's all nice. It's of a certain size and a certain scale. Do you think you're sort of comfortable with what you've got, or once this is all out of the way, you're going to be looking around to have conversations with other parties? We talked before about, obviously, you've got Jervois relatively down the road in Idaho, but there's a few other sort of smaller players where perhaps cobalt is not their thing.
Well, there's a couple of ways to take that. On the mineral asset side, our Iron Creek deposit has been kind of sitting in the shade here for the last couple of years, and it's time to get back at it. So you're going to see us drilling and spending on that. We've got some geophysics results that we've completed, and we need to share with the market, just looking at extensional opportunities, regional satellites. And so, next to Jervois, we've got the next most advanced project in the belt. There's a lot of speculation now on the blogs that First Cobalt's going to start rolling up all these other juniors in the cobalt belt. And we've done enough M&A. We're going to execute on what we have. My shareholders deserve to enjoy this ride, right? And we can look at earnings and whatnot, but we got our hands full. Where we might, so we'll grow that resource. I'm confident we're going to grow that resource over the course of the summer. I think I can say that, but feeling really good about what we can do there, because there's just a lot. We never stopped hitting mineralization on good widths, right? 10, 20, 30 meters. So where do you go next? I think the next growth opportunity for us is still at the refinery. I think the battery recycling market is in its nascency in the Western world. And while we're really recycling a lot of consumer electronics and power tools today, that's actually a net benefit because they're cobalt heavy relative to battery car batteries. So if we can position our refinery as a hydromet plant to receive the black mass that's being processed and being sent to pyro facilities as opposed to ours, we should achieve a much better recovery and a lower operating cost compared to the established hub and the hub and spoke model So I would say stay tuned there. That to me is the next exciting piece for us.
Okay, well, let's talk about the thing that I want to talk about, which is the feedstock agreement, right? Because that's really important. That really does can affect your margin, something that you know not necessarily fully in control of. So, where have you got to with it? What do the numbers look like?
Yeah, so given the counterparties we're talking to, you know, the OEMs, the Western OEMs, provenance of your material is critical, right? I mean, artisanal mining and ethical sourcing is table stakes. You got to have that dealt with, and then we'll talk about your environmental footprint. So, you know, I think we've dealt with that in spades here, and it's gotten the attention of the people we're talking to on the other end. If I were to, you know, kind of dream of who I would want to have a feedstock with, it's where we landed. It's the Tenke operation, former Freeport, now China Moly, and it's the KCC operation, Katanga of Glencore, and those are the two highest quality, biggest, best commercial operations in the DRC, and so. There's not a doubt, and look, we've got to certify it, and we've got to go through our supply chain diligence. We're going to be applying the same tools, the same management systems, the same third-party audits to get there. But there's not a doubt in my mind; these are big commercial operations. They are well run, ethical sourced, and the quality of the product is second to none. So I'm really excited we landed where we landed, and you know we're well set up. And what was interesting to me, Matthew, as we got into this as a junior company getting started. In a world of giants was the level of interest on the part of almost any miner we talked to for finding a refinery that would be ex-China with 80% of supply going there. There is everybody's looking at supply chain nowadays post-COVID. The idea of a Canadian refinery really got a lot of attention. And on the investor side, now that we've actually identified the two giants in the space, it sets us up well for execution.
It does, and the people are always going to ask about the ethical components. You're saying OEMs, battery manufacturers, they're happy. You've done your own diligence, you're happy, and you think that the fact that the cobalt is coming from where it's coming from, people should not be concerned.
Yeah, absolutely. I mean, most of the world's battery grade cobalt is coming out of those copper cobalt operations, and so there is a lot going on. There's an artisanal mining alliance in the DRC. There's government initiatives. There's industry-led initiatives. Tesla and Glencore are part of the same artisanal alliance. It's just to try to clean up that part of the supply chain. We can't play there. We're too small. We can't play in that area. I hope it works. And artisanal mining has a place in the third world. It just can't come to our refinery. It hasn't come of age. So we're going to rely on the big commercial operations that we can comfortably audit, direct ship from their mine to our refinery. No traders, no blending. And then there's some blockchain initiatives that Glencore is working on. And we would hope to fall in line with that. But in the meantime, again, let the big boys and girls figure it out, and then we'll toe the line. But in the meanwhile, we've got the Cobalt Institute initiative, SRAF and RMI, and we're going to comply with that. And then it makes for a very seamless certification process from mine head out to the other end of our gate.
Okay, so we had Kuya on last week, Kuya Silver on last week. You've just obviously that deal got done. What's your version? Was it a good deal? He wasn't so sure. I'm kidding.
It's a fabulous camp, and so this is how the company was founded, right? It was a three-way merger that got us, the pole position in the Canadian cobalt camp. So we made it to rebrand it a little bit. Cobalt is the name of the town, but the town historically, it was more silver with cobalt byproduct. And so as we started drilling, look, we had spectacular silver grades there, and no surprise to anybody who knows that camp with 100 past producers. So. Under their watch, they're going to buy, a big piece of the land package. We're going to joint venture the rest. We've got a great position here with three great assets. We have that asset, we have Idaho, and then we've got a refinery. We just don't have the time and the bandwidth to get to it, but we're going to participate in the upside with, shares of Kuya. We'll have the cash payments and we'll have the JV. So I think it's a win-win, and we're going to help them. We've got the best data set of anybody in that camp. And I think there's a lot of unfinished business, because as we were looking for cobalt, our model 3 years ago was big disseminated open pit cobalt or base metal deposits. The results we have are really amenable to these very high grade structural deposits, sort of underground vein style systems. And there's a lot of unfinished business that we never bothered to follow up on. So I think they'll be able to hit the ground running. Probably surprise the market with their very first drill program.
Right. I get the upside, sharing some of the upside, great. But how much cash was involved, and when do you get it?
So on closing, we're working on the docs now. So maybe by Feb, we'll close $1 million in cash, $3 million in shares. That gets them the first land package, and then there's an option in JV for a bigger land position that triggered with $1 million payment. And then there's a bunch of other sort of milestone and triggers down the line. So call it $4 or $5 million in consideration here in the next 6 months.
Would you check out in terms of, would you cash in on the shares relatively quickly?
I don't know that I would now, right? Our cash position is great and growing. So I'd like to kind of ride that benefit and look there, I view this as a partnership, so I don't want to hurt them. We'll see where we go. But the cash, we're not in a rush to sell the shares by any stretch.
Yeah, no one ever wants to hurt your partner, but at some point your needs are different from their needs, and you'll have a conversation about the timing and how you do that, would you? Okay.
Yeah, absolutely, yeah.
Good man. Okay, before we go, can you just remind me, because there's a lot of moving parts there now, because you've got the money to make sure that there are. What's the sequence of events that we should be looking out for going forward?
Yeah, so the two things that are going on right now, well, three things, I guess. The Treasury continues to grow, and so we've got discussions in hand now with Ausenco for an EPCM contract, and so that'll take that's probably the next thing to get announced, I suppose. What that looks like. It won't be a fixed price to brownfields. We're going to have a decent sized owners team, and it's a small capex, so we feel pretty good we can mitigate the risk with the oversight, technical advisory boards and the like. After that, it'll be the financing, which I don't think we'll hit it at the end of March, but it shouldn't be far beyond that before we can announce that that's in place. All the while, as I mentioned, we're doing long lead, we're doing procurement work and detailed engineering, lots of optimization. But if you want to look at on the ground construction, then early summer we get to work and start, erecting the first building. Not essential. A lot of this is equipment, right? We got to order in and spec and whatnot. So the next 18, 20 months is going to be just the ramp up and commissioning. First feed is scheduled to come to our site October of 2022. And so the schedule is driving towards that, and we're looking pretty good.
Have you spent much time in terms of the recruitment component? Because you're going to need a whole bunch of people. Because you told me last time, skeleton staff. You're watching that G&E, right? So have you had the conversations with the teams or individuals that you need on board, and are you confident in getting them, in time? Yeah,
we've got a kind of a two-stage, probably a three-stage hiring process. So I'm cautious with the Treasury. Again, I'm an investor, treat it like your own. But there comes a point, Garrett McDonald, my board, who worked for JDS, he's an EPCM guy, and he's a Trent. At some point, you just got to take the plunge, right? And so we had that chat, the chairman and I, and Mark Treviso, who ran the Glencore smelter and is leading this project. It's time now. It's time to spend responsibly, but we got to hire a team. So we've got our top metallurgist will be coming in the door here shortly. It's a small team. It's going to be a 4 or 5 person owners team with Ausenco kind of carrying the load. And then when we start on the construction, then you hire a few more bodies, and we've got lots of time to figure out the operator team. So the people we're bringing in now will likely stay through operation. But I think with the experience and I guess the track record that Ausenco has built on execution of plants, we feel pretty good that we're going to be able to lean on them in the early days as we build up our own capacities. And I've got personal friends in the senior ranks of that organization, so that helps as well. There's a high level of trust, and they've proven themselves with us over the last year.
Okay, so G&A will remain tight.
Well, yeah.
Good. Okay, Trent, look, good to catch up with you. I just wanted a quick update, because obviously, like I said, in the space of 6 weeks, a lot's happened. We'll be watching you. I think Cobalt could be interesting this year. Stay in touch, okay?
Will do. And I would just add, Matthew, in conclusion, that with the Biden administration, I think America is underestimated for its EV potential. Biggest consumer market in the world. We saw what happened in Europe, surpassing China, doubling EV sales in a year. Watch America, because even independent of the U.S. election, we're going to go from 16 models of EV in 2020 to I think it's 38 this year, on track for 121 announced in 5 years' time. Now you overlay a $2 trillion clean energy plan and a friendly White House. I think our timing could be really good.
Yeah, again, I think it's another big discussion to be had. But okay, like I say, stay in touch. Let us know how you're getting on. We'll be watching you. Okay?
Okay, thanks very much. All the best.